If the vaccine situation wasn't critical enough, the IMF also sees a second major issue looming close behind, that of inflation. The WEO echoes the chorus of economists warning that price rises could become more than just transitory. On this programme last night, you'll remember, Mohammed El-Arian told me he worries that the inflation that is here may be here to stay.
I believe that inflation will prove less transitory than the Federal Reserve. I believe that we are in the midst of an inflationary process. It is not the 70s and the 80s, but it is 3 to 4% inflation that will last for much longer than most people expect.
Now, here in the United States, the Federal Reserve has so far resisted calls to raise interest rates to help curb rising prices. The chair says, Jay Powell says, he believes the recent spikes in inflation are transitory and appear eager to avoid the sort of taper tantrum that rattled stock markets when the Fed started raising rates after the financial crisis. In my conversation with the IMF Managing Director, she told me she worries the Fed could act too soon on rates.
At this point, what we see is primarily transitory factors affecting inflation. In other words, we have pent-up demand and we have big disruptions in supply, and they put pressure on prices. Also, this rapid recovery in advanced economies means that pressure on commodity prices is also going up. We think this is going to ease out as the recovery advances. But if we don't overcome this dangerous divergence, then we may be in a situation when supply disruptions continue and they hit back on prices in a way that is more in the view that you just expressed.
Is it time for the US to start, and I note I say start at the very beginning, but start the normalization by, for example, tapering? Is it time to, I guess what I'm asking you, I can put it as politely as I like, but I'm asking, are you a dove or a hawk when it comes to raising rates and tightening in the US?
I am very watchful and get evidence to take us to the advice we give. And in that spirit, Richard, what we are seeing is already the Fed is contemplating that there may be an acceleration of withdrawal of this massive support. In our own projections, we expect that it would happen earlier, maybe in 22, not later as we initially projected, because of this very robust recovery in the United States. And this is why we are ringing the alarm bell. If emerging markets continue to drift backwards, fall behind, when this tightening of financial conditions happen, we might see a second shoe to drop. We may see countries with high level of debt, especially dollar-denominated debt, in a very difficult condition. We have to accelerate through vaccinations and through more fiscal support for these countries the ability to grow faster so we don't risk a problem down the road that, if we act today, is avoidable.
Final question. You've seen many financial crises from the policy side. I've covered many financial crises from the journalism side. This is the most difficult in a sense because all the economic levers and answers and prescriptions rely on the health scenario first. Is this the most tricky that you've seen?
It is by far the trickiest. But on the other hand, we also have answers that are staring us in the face. Vaccine policy, Richard, is economic policy. Vaccinate. We also see that collectively, we can support those that are in the most difficult condition. The IMF is going to issue $650 billion equivalent of special drawing rights. This is a shot in the arm for finance authorities in developing countries that are desperate for more fiscal space, both to help their own people, to vaccinate them and to support their businesses, but also to catch up in the world economy so the engine of recovery goes faster and farther.